What is up, YouTube? I'm Adam Odell, Chief Investment Strategist of moneyandmarkets.com, and I'm joined by my research analyst, Matt Clark, and we're here for yet another episode of Ask Adam Anything. So I did get a brief preview of this week's question, and it is a subject that's near and dear to my heart, so I'll let Matt take it away and pose the question that we got from an interested subscriber.
Thank you. Appreciate that. And again, thank you for joining. Each week is always something new and always something very exciting. And I look forward to being able to sit down and not really grill our chief investment strategist. It's not as if I'm sitting across from a politician. I'm raking over the coals for being corrupt or anything like that. So it's not quite like that. But I do like to kind of either get into Adam's wheelhouse and really get his mindset, or I like to kind of trip him up if I can and maybe make him really think about where we're going. And this time, I'm going to go right into the wheelhouse. And I covered this topic before in a previous Bull and Bear podcast. You can check that out on our YouTube channel. But I wanted to bring in Adam and really get his take on it. We've kind of curved off of the earnings season. Things are, we hit a peak, and this happens every quarter where it starts off in a fury, it amps up, and then it starts to kind of drift off a little bit after big tech earnings and things like that. And then it just kind of filters out and we start the cycle all over again. But, a question we got from a reader, and this is one that, I tackled, but I want Adam to get into too, is, should I trade ahead of earnings? And I think this is interesting because I think there's a lot of there's a lot of opinions in terms of how one would trade in either before earnings, after earnings, or during an earnings report. And I want to get Adam's take. Adam, should I trade ahead of earnings?
Yeah, so it's there's never a yes and no answer with me. I think you should know that by now. So I'll start off by saying, trading around earnings for the sole sake of trading around earnings is a tough business. Okay, so if that is your main strategy, like I'm going to try to guess or estimate or forecast or predict what is going to happen, what type of price action the stock is going to develop in the wake of an earnings report, that's very tricky. So first of all, obviously you have analysts' forecasts and expectations out there. So the stock can move differently, whether you get a beat of those forecasts or whether they miss. Also, you don't know how much is priced into that forecast. So if all investors are expecting the company to beat analysts' estimates, then that may already be priced into the stock. You might have gotten a run up in the stock heading into earnings, and then it might be a case of, buy the rumor, sell the news, so that actually the stock sells off after that beat. So there's a lot of game theory involved. It's not as simple as if the company, shows growth, then the stock is going to jump. It's not as simple as if the company beats estimates that the stock is going to jump. There's a lot of game theory in there where you have to figure out what's priced in and what's not. And sometimes you can really be surprised by the moves. Now, the second part of this question, or the second part of the way I look at it, is that you do get bigger moves. You can get bigger moves around earnings releases. So obviously the stock market tries to incorporate all publicly available information as quickly as possible into the price of a stock. And obviously scheduled earnings reports gives everybody a chance to line up, read that report or listen to that earnings report call and make a decision on how to quickly incorporate that information. And they start buying and selling the stock based on that. So you can get big moves. The problem, technically speaking, with trading around earnings is kind of twofold. First of all, if you're trading the stock outright, if you're buying shares or even selling short shares of stock, you have what's called gap risk. Okay, so if you're trading something that's volatile and you're doing it over a short period of time, you're probably using stop losses. So you said, I'm going to get into this trade, and if the trade goes against me by 5% or by 10% or some specific, you draw a line in the sand and you place your stop loss level at that level. And you're basically telling the broker, look, if the price goes against me by this much, then I want to close the position. I'll take the loss so I don't get a larger loss and I'll get out of it. Well, you have gap risk, especially when earnings are released outside of market hours, like after the close on one day. That stock is probably going to open up the following morning at a far different price than where it closed. So that's called a gap. And if your stop loss order is in that gap, you are actually probably going to lose more than you thought you were going to lose. So if the stock goes against you and it gaps over or beyond your stop price, in this case, probably the case under your stop price, then you may think that you're going to get out at a no more than a 10% loss, and you may actually get out at a 12 or 15 or even 20% loss, depending on how far that stock gaps. So that is one of the, I'll say, technical challenges with trading stock, or actually buying shares of stock ahead of an earnings report. Now, the other way to do it, and a very popular way to do it, would be to buy options. Okay. And there's even a very clever way to trade an earnings report. And it's basically buying a straddle or a strangle. And what that basically says is you're going to be buying a call option, which benefits if the stock price goes up, and you're going to be buying a put option that benefits if the stock price goes down. And you think, well, first of all, I can win either way, whether the stock goes up or the stock goes down. I'll have one half of my position that way. And then the other idea is that that straddle wins if you've bought the straddle, if the stock makes a big move. And most people think, all right, well, around an earnings report, stocks make big moves. So let me just buy this straddle, whether it goes up or down by a big amount, I'm going to win some money. But that's not always the case, again, because of the pricing of that straddle, or even maybe you're bullish on the stock and you don't buy a straddle, but you buy call options, which is a bullish bet. So you buy call options ahead of the earnings report. You think they're going to beat, you think it's going to jump 10 or 15%. And so you buy those call options. Well, the biggest mistake that especially novice, new options traders make when they buy options, especially ahead of an earnings report, thinking that they're going to get a huge move, is they overpay for those options. So just like stocks can either be a good value or overpriced, option contracts can be a good value or overpriced as well. And there's a couple of ways to determine that, but it's all based on what's called implied volatility. So if you look at your options trading platform, whether it's Thinkorswim or Schwab or whatever platform you have, there's going to be a column that shows you the implied volatility of that option contract that you're considering buying. And it's going to be in a percentage term. And what it's actually saying is the annualized volatility that investors expect from that stock. So it could be 20% if it's a not very volatile stock. It could be 50% if it's a little bit more. These days, there are certainly stocks that have implied volatilities over 100. Okay, so that would be basically meaning that we're expecting a 100% move either direction over the course of a year. So high volatility. And the thing is when you buy an option contract, whether that contract costs $100 or $200 or $300, it's influenced by how much volatility other market participants think that stock will have ahead. So if Matt, you and I, and everybody else that we know thinks that a certain stock is going to be super volatile over the next month, we would be willing to pay $300 for that contract versus just $100 if we thought it was going to be low volatility. So that's how volatility is factored into the pricing of an option. It's called implied volatility. Two things that I do to make sure that I'm buying cheap options, basically not cheap on the exact dollar amount, but relatively underpriced or undervalued, is I'll make two comparisons. First of all, I will look at the implied volatility, which is basically saying how much money do I have to put into this option contract to get exposure to the volatility. I look at the implied volatility relative to the historical volatility. So just to use round numbers, if the historical volatility is 100%, meaning the stock has had actually over the past year has had that much volatility, 100% level, then if the option is priced at just 50% volatility, meaning far less than the historical, that means it's underpriced. That means for some reason, nobody's really expecting much volatility out of the stock relative to how much volatility it usually has. So that would be an underpriced option. So that's one thing I look at. The other thing I look at is the 52-week range. So a trading platform I use, Thinkorswim, uses basically a 52-week range of implied volatility. So let's say the implied volatility is 25 today. It will tell me where of the last year of all the implied volatilities of this contract, where that is. So is 25% really low? Is it in like the lowest 5% of the range, or is it really high? Maybe it's in the 95th percentile of the range. So that's the other thing I look at. So the sweet spot is if you can buy an option where the implied volatility is less than the historical volatility, and also where the implied volatility is in the lower, I'll say, quarter of the 52-week range. That means you're buying a cheap option. So if you can find a stock that you're bullish on heading into earnings, and you can find an option on that stock that is cheaply priced then trading around earnings can be a great strategy. But you have to really pay attention to the pricing. It's not as simple as thinking, I'm going to get a big move, I'm going to watch this earnings report come out, and my options are immediately going to pay off. Especially these days with new retail traders jumping into the options market. I mean, the options flows are ridiculously monster right now. And everybody's just trying to, they think it's a matter of like, if I think the stock's going up, I'm going to buy call options, and they're price insensitive, in my opinion. So the market makers know this. So whereas maybe 18 months or 24 months ago, a market maker might have priced an option at $100. They now know that they have all this retail order flow coming in, and that retail order flow is going to be willing to pay $150 or $200, $250 for that same contract. So they just mark up the price, and they can do that. So that's really what you want to be wary of and careful of if you want to try to trade around earnings.
So the key here is if you want to trade around earnings, I think Adam's laid out some very good points here, especially looking at implied volatility, 52-week range. But you really want to do your homework and make sure that if this is really what you want to do, that you highlight, the stock you're looking at, check the options, and check that implied volatility, check that 52-week range, and see if you're buying this stock overvalued. Is it overvalued right now on an options contract, or is it undervalued? You want to look for that undervalue to make sure you're getting the most bang for your buck. Adam, I appreciate the time. Thanks so much. I thought that was a great take on trading ahead of earnings. And I think as we head into the next quarter of earnings, which is coming up here in another month or two, I think this is good, something good for traders of any level to understand. So if you do have a question or a comment or anything that you'd like us to take a look at or examine, you can do that. Just email us. The email address is feedback@moneyandmarkets.com. We'll put that email address down below. You can have a question for Adam, for myself, for Charles Sizemore. We love to look at that. You can also comment below on our YouTube page here. We'd love to look at those as well. If we do use one of your questions, whether you submit it to us as a written question or a video question, we're going to line it up and get you some free Money and Market swag. I have some hats around here. We've shown them before, but we've also got some hoodies and things like that we're working on as well. So again, it's feedback@moneyandmarkets.com. Send us your questions. Send us what you'd like us to take a look at, and we would love to see what is on your mind. So for Adam O'Dell, Chief Investment Strategist with Money and Markets, I'm Matt Clark, Research Analyst. Until next time, everyone, safe trading.